Here's something almost nobody tells beginners. The single biggest factor in how smooth or how stomach-churning your investing journey feels has very little to do with which fund or stock you pick. Studies have found that more than 90% of how bumpy a portfolio's ride is over time comes down to one decision: your asset allocation. So let's find out what that actually means and how to get it right. When most people start investing, all their energy goes into one question: what should I buy? Which stock? Which fund? Which hot tip? They treat it like picking the winning horse. But the professionals think differently. Before they ever choose a single investment, they decide on the recipe. How much of the whole pot goes into different types of investments? That recipe is the thing that quietly shapes everything that follows. So what is asset allocation? In plain terms, it's how you divide your money across the main types of assets. The two big ones for most people are stocks and bonds. Stocks are tiny ownership stakes in companies. They can grow a lot, but they swing wildly. Bonds are loans you make to governments or companies that pay you steady interest. Calmer but slower growing. Asset allocation is simply the split. Maybe 80% stocks and 20% bonds, or 60-40. That ratio is your portfolio's personality. Let's look at the two ingredients side by side because they do opposite jobs. Stocks are your growth engine. Over long periods, they have historically delivered the highest returns, but they can fall 30, 40, even 50% in a bad year. Bonds are your shock absorber. They grow more slowly, but they tend to hold steadier and sometimes rise exactly when stocks are falling. You're not choosing one over the other. You're blending them so the strengths of one cover the weakness of the other. Here's why the mix matters so much. Picture two investors going into a major market crash like 2008. The first holds 100% stocks. The second holds a 60-40 blend, 60% stocks, 40% bonds. When the crash hits, the all-stock investor watches their portfolio fall by around half. The 60-40 investor falls too, but only about 30%. Same storm, very different ride. And here's the human part. The calmer investor is far more likely to stay invested and actually be there for the recovery instead of panic selling at the bottom. So how do you choose your own mix? The most important question isn't how brave you feel. It's when you'll actually need the money. This is your time horizon. If your goal is decades away, like retirement at 25, you can lean heavily into stocks because you have time to ride out the crashes. If you'll need the money in just a few years, a house deposit, say, you should hold far more in bonds and cash because a crash right before you spend it could be devastating. The longer your runway, the more risk you can responsibly take. Because your time horizon shrinks as you age, your allocation shouldn't stay frozen. It should slowly shift. Boss, this is called a glide path. When you're you might hold a large slice in stocks. As you get older and retirement gets closer, you gradually move more into bonds to protect what you've built. A classic rule of thumb is to subtract your age from 120. That's roughly the percentage to keep in stocks. At 25, that's around 95% stocks. At 65, it's closer to 55. It's not a law, just a starting sketch. There's one last habit that makes allocation quietly powerful: rebalancing. Over time, your mix drifts. If stocks have a great run, they grow into a bigger slice than you intended. Say your 60% becomes 75. Rebalancing means trimming what grew too big and topping up what lagged to get back to your target. Here's the beautiful part. This forces you to sell some of what's expensive and buy more of what's cheap, automatically without emotion. Doing this once a year is enough for most people. And this is the deeper reason allocation matters more than almost anything else you'll do as an investor. You can't control whether the market goes up or down next year. You can't reliably pick which fund will win. But you can completely control how your money is split between growth and stability. And that single choice shapes how much you make, how much you risk, and crucially, whether you can stay calm enough to stick with the plan. Get the allocation right, and the rest gets a lot easier. Let's bring it together. Asset allocation is how you split your money between stocks and bonds. Stocks are your growth engine, Bonds are your shock absorber. Your time horizon when you'll need the money I define should set the mix, and it slowly shifts toward bonds as you age along a glide path. Rebalance about once a year to stay on target, and quietly buy low, sell high. That's the whole framework, and it matters more than any single stock you'll ever pick. If this made allocation click for you, the natural next step is understanding the engine inside the stock side of your mix, index funds, and how they give you the whole market in a single low-cost buy. That breakdown is right here. And remember, this is education, not financial advice. Your right mix depends on your own goals, so do your own research or talk to a qualified professional. Subscribe for more money concepts explained simply, and I'll see you in the next one.